In this episode, we are going to look at the setting of standard costs. Standard costs are the expected costs for producing a product or providing a service that are preset by management. You can think of it as budgeting on a per unit level. These standards are based on carefully predetermined amounts, and they are used for planning labor, material, and overhead requirements. They are based on expected levels of performance, and they are used as benchmarks for measuring performance. When setting these standards, the question becomes, should we use practical standards or standards that are really obtainable, or ideal standards? Ideal standards would be, in a perfect world, could we achieve these standards? Practical standards should almost always be set at levels that are currently attainable with reasonable and efficient effort. We can't expect ideal, perfection. We have to be setting our standards in practical levels. So let's look at the setting of direct material standards. In other words, what kind of direct material costs do we expect on a per unit level? The price standards would be based on competitive bids for the quality of materials and the quantity that we are going to be needing. For quantity standards, we would use product design specifications. What amount of materials should be used for each unit produced? So the standard material cost for producing 1 unit of product would be the standard price that we anticipate paying for 1 unit of material, and the standard quantity, or how much material should be used to produce each unit of product. When setting our direct labor standards, our rate standards would be based off of using wage surveys and labor contracts. Time standards. We would use time and motion studies to identify what the true attainable time would be for each individual labor to produce each unit. Thus, our standard labor cost to produce 1 unit of product would be the standard wage that should be paid to each hour of labor, and the standard number of hours that should be used to produce each unit of product. Finally, setting our variable overhead standards. The rate would be the variable portion of the predetermined overhead rate. And the activity standards would be the activity that is used as the cost driver when we were calculating the predetermined overhead rate. Thus, the standard variable overhead cost to produce 1 unit of product would be the standard variable overhead rate for each unit produced, and the standard number of activity units for our cost driver in producing 1 unit of product. So if a company were to prepare standards to produce 1 unit of inventory, we could see an example of a standard quantity of 1 kilogram of materials at a standard rate of $25 per kilogram. Each unit produced should incur a standard cost of $25 for materials. For labor, the standard quantity of labor would be 2 hours of labor for each unit produced at a standard rate of $20 per hour. Total standard labor cost, $40 per unit produced. And finally, our overhead, the standard quantity would be 2 hours at a standard price of $10, or a standard overhead cost of $20 per unit. So when we are budgeting on a per unit basis, the standard should be $85 in variable cost for each unit produced.